step 5, right? Remember that when we started, we said there are 5 steps that we would follow in to identify and process the revenue under the IFRS 15. These are the 5 steps. We are focused. We have already completed the first 4. So the 5th steps is recognizing the revenue when the performance obligation is completed, satisfied, right? So we need to recognize, in the 4th steps, we were able to allocate the transactions price according to the proportion of the standalone prices of those performance obligations. Right now, here we would try to recognize them, and let's focus on this step 5. Right, let's read. I'll start from the example, and then I'll come back to the notes on the top. Right, so here we have a nice example here. Then I will explain you. Right, so here we have Gerard has entered into a sales contract with a customer to construct a specialized asset. So there has been a contract between Gerard and a customer to build a specialized assets, right? So the performance obligations, now the point that we need to focus here, right? So this is what you need to understand from this particular step, right? Performance obligations, you can come the revenue of the performance of, I don't know why this is just vanishes, the revenue of the performance obligations, right? It can be considered as satisfied in 2 different ways, right? One, at the point of time, right? At a point of time. For example, say I promise to sell you a box. Just say that this is the square, which this is the circle, right? I promise to sell this to you, right? So I promise to supply this to you, so that and then you promise to pay me 50 quid, right? So the minute that from my point, right, from my point here and to yours here, right? So the minute that you receive these goods from me, right, and in particular, you have control over the assets. We're going to look at it in detail, right? So once you receive and you have control over the assets, at that point of time, from my end, the performance obligations, I have an obligations to complete the performance. That means to sell, to send, to supply this particular asset to you, would be considered as satisfied, would be considered as completed, right? That's one point. And on the other would be that sometimes performance obligations can be considered as sort of a completed over a period of time, right? Say like, for example, and I have promised to build you a 3-story house, right? A 3-story building, right? And say that when I completed the first story of this building, I let you in, and then you were occupying this property, right? And then I was continuing the building. Let's say it's 4-story, right? That's much more easier to explain, right? So here, when the performance obligations is completed, right? The promise was to complete the whole 4-story building for you, right? But I have given you control. You have already, when I completed the first 25%, you have already walked into the building and you're occupying it, while I was doing more work of enhancing and completing the rest of work. So here, at this stage, say this was done in 31st of December, on this particular date, and it is considered as 25% of my work has been completed, right? So performance obligations is satisfied. 25% of the performance obligation has been considered satisfied. So likewise, once I complete the work more based on the progression of completion, right, the performance obligations will be considered as satisfied over a period of time, right? It can be considered satisfied at one single point of time, or it can be satisfied as over a period of time. So let's read this question now. We still don't know. We know now Gerard promises to construct a specialized assets, maybe a child free leg, right? So he promises to supply the construct specialized as the asset to you, right? So the customer has paid a deposit. So you have paid a deposit to Gerard, right? Which is only refundable, right? Which is only refundable if Gerard fails to complete the constructions, right? So the, this particular sentence is giving you a clue. What does it mean? If you just read from Gerard's point of view, Gerard would have no entitlement for this deposit until and unless he completes the construction. That means chair with the three leg. Once he only complete that construction of that particular chair, then only that he can touch this deposit, right? He become entitled. That means the performance will be considered as completed when only at a point of time when that chair is completed and given to you, right? So then if we move on next, the rest of the consideration of the asset is payable when the asset is delivered to the customer. So it's this second particular point, it's proof further that what I've said here, right? So here the performance is not considered as completed over a period of time. It is not over a period of time. Why? Because Gerard, for example, say when you build the first leg of that chair, and Gerard can touch the 10% of the that deposit become entitled to him. If that was the case, then performance is considered as satisfied over a period of time. But here that's not the case. Here Gerard can't touch he's not entitled to the deposit that you have given if he fails to complete the chair. And also he can't even claim, say like he done two legs and only one leg left to complete that asset, right? Still he can't claim any considerations for the work completed from you, right? There is no entitlement at all. So there is only one point of time where Gerard performance is considered as completed, satisfied, would be when the chair is fully constructed and then delivered to you. That's the point where Gerard would become entitled for the remaining cash, and also that deposit that will become is paid to him, also he will become entitled to him, right? But on the other hand, if the customer defaults on the contract prior to the completion, Gerard has the right to retain the deposit, right? So if the customer defaulted before you complete, then you are entitled, Gerard is entitled. So the question here is that discuss whether Gerard should recognize the revenue from his contract by measuring the progress towards completion of the asset. So they're asking you, is this the way Gerard should recognize the revenue? That means once he completed the first two legs, he can claim the revenue of that percentage. Can he claim like that, or the second approach? That means he has to wait until he completes the full chair, complete the whole asset, then only become entitled to recognize that as a revenue in his book. Which method that we would use? That's the question here. Let's read the answer, and then we'll come back and read the theory on top, right? So that will make a good understanding of the topic, right? So the question that we have here: when should Gerard recognize his revenue? Does he have to wait until the asset get completed, or can he recognize over a period of time? That means based on the work completed, percentage of the work completed. Let's read this. The first part here, right? The first one here, it says revenue is recognized by measuring the progress towards completion of the asset only when, right, performance obligation is satisfied over time. That means what? We can only recognize revenue by measuring the progress towards completions of the asset, like this, right? Measuring the progress of towards completion, 25% of the work completed, so we can claim 25% of the revenue as recognized. We can recognize over a period of time based on the work completed, right? We can only do that. We can only recognize revenue over a period of time when the assets, right, so towards completion of the assets, only when the performance obligation is satisfied over time. So as I pointed out, there are two ways in which the performance obligation can be satisfied. One, at a point of time. Second one, over a period of time. We're going to look at the conditions in a minute. So the Gerard must determine, right, its promise to construct the asset is performance obligations satisfied over time or at a point of time. So this is the question that we had here, right? So is this contract, right, under this contract performance obligation, is this performance obligations gets completed over a period of time, or performance obligations considered as satisfied at a point of time. Which one? This is what we need to um, make a decisions, right? That's our part here. So let's, if we move on further, the during the construction period, Gerard has a right to the deposit paid and not to the rest of the consideration. So while the work was going on, Gerard has no right. Only the right that he has is the deposit money paid, because work has started, and then if the other party defaults, so he can keep the deposit, but he cannot claim the rest of the considerations. Even though say 75% of the work completed, he can't claim anything more, right? So because he has to wait until the work is completed, so therefore it would not be able to receive payment for the work performed to date. That means if 75% of the work get completed, he can't claim for the 75% of the work money. He has to wait until it's fully completed. That means this is not a performance satisfied over a period of time, right? So if we move on further, additionally, Gerard has to repay the deposit should it fail to complete the constructions of the asset in accordance with the contract. That means, say Gerard, after completing nearly 80% of the work, and then due to some factors, Gerard has to quit the contract. So in that case, he can't claim. He has to repay the deposit, right? So again, the work completed, he can't claim the money. And if you move on further, it says, therefore, um, this is a single performance obligations which is only met on delivery of the assets to the customer. So that's the point. When the asset get delivered to the customer, that's where Gerard would get entitled to the considerations, right? So this is a consider performance obligation is satisfied at a point of time. Therefore, Gerard should recognize at a point of time, right? The revenue should be recognized at a point of time, like being the date the asset is delivered to the customer. So now we have a rough idea of what is this whole issue is about, right? We identifying when the performance is completed, right? And then you recognize the revenue accordingly. So now let's look at the notes that we have here, right? Then I will do the other. The one part is the FRE in detail, and then the financial reporting, and then this is the SBR notes, right? So the first one, just we read quickly. A performance obligation is satisfied when the entity transfers a promised goods or services to a customer. That's we know, right? If I promise to deliver a box to you, right? So my performance obligation is considered as satisfied, completed, only when that you receive the box. You have control of that box, right? So if we move on further, an asset is considered transferred when they see how it develops, right? The first one, the performance obligation is completed when I transfers the goods, the box to you. When I give the box to you, transfers the box to you, that's where the performance obligation is considered completed. So what do you mean by transfer, right? So for example, if if I'm giving you an asset, right? When I send you an asset, transfer means in terms of when I send you an asset, that means you are having complete control of that asset. That's what you mean by transfer, right? So for example, I send you a car and then I keep the keys with me, right? The car is with you, but you have no control over the car, right? So that doesn't mean, yes, it has been transferred, delivered, but you have no control, right? And so a transfer means that who the customer, you obtain control of that asset, right? Now we're going to move on from there to focus on what you mean by control. Control means what? Control means that you have the ability to direct the use of the asset, and also you have the ability to obtain substantially all of the remaining benefits from the asset. So this is what means. So in a nutshell, um, performance obligations will be considered satisfied only when an asset get transferred to you, right? Promised assets you will get transferred to you, but that transfer, right, is considered, right? When we consider a transfer, only when that the customer that you receive, or you have the complete control of the assets and also substantially all the benefits, remaining benefits that you become entitled. That's the point where that you will be considered as having the transfers and having the control, right? I hope it's clear. So you need to focus on what you mean by transfer, and then you need to thereafter you will build on first definitions would point you towards transfer. That's where the assets will become obligations is completed and satisfied. Then what you mean by transfer, giving you the you having the control. What you mean by control, you receiving the complete remaining benefits of the assets. Now let's move on. As I pointed out, right? Transfer of control of a good or services, right? Transfer of control. That means you're transferring the control. So that's the performance obligations. It can be achieved in it can be achieved in two different ways. The first one here, satisfaction of performance obligations over time, like I explained you, completing a building, right? Let's come back to that in a minute. And then the other one, which we have just looked at it, satisfying the complement of achieving the control, right, at a point of time. That means the performance obligation is considered satisfied at a point of time. So as I pointed out, when you if the contract says that I will be entitled, right, for my considerations only when the goods are delivered to you, that means that is performance completed at a point of time. I don't know what's going on here, at a point of time, right? It is considered as at a point of time, right? And so in order for us to help to determine, right, whether performance obligation has been delivered at a point of time, completed at a point of time, these are the key indicators that we would look for. First, the entity has a present right to payment for the asset. That means, I promised to send you a box. Now I have sent my box, so I've become entitled for the cash. So that's when I have the present right to the payment, then that will be an indicator that it is a performance obligations at a point in time, right? So here, to determine the point in time when a customer obtains control of a promised assets and entity satisfies performance obligations, the entity would consider the indicators. These are the key indicators. And when the customer has legal title to the assets, I transfer it now. I transfer the car to you, and you have the legal title now. So that is an indicator that the at a point of time, at that particular point of time, obligation has been completed or transferred physical possession of the assets. That's another one. And then the customer has significant risk and reward of the ownership of the assets. Everything, the complete risk and reward has been transferred to you, and then the customer has accepted the assets. These are the indicators that would help you to identify that point in time when the performance obligations get completed, right? So the next one here, as I pointed out here, these are the circumstances under which that performance criteria that you need to meet, that the performance obligations will be considered at satisfied over a period of time. The performance obligation is satisfied over a period of time. So in order for us to um, consider the performance obligations to be completed, to be satisfied over a period of time, these criteria need to be met. So an entity transfers control of goods and services over time, and therefore satisfy the performance obligations and recognizing revenue over a time if the following three criteria are met. If these three criteria are met, so right, then the entity can recognize its revenue over a period of time. So for example, I promise to complete the four-story building, right? And so the whole contract was 400,000. When I complete the first story, I can recognize 100,000 as my revenue over a period of time based on the completion of percentage of completion of work, right? So these are the conditions. First, customer simultaneously receive and consumes the benefit, as I pointed out, here. And the four-story building that I've given you an example earlier. And so these are the four-story building that I've given you an example earlier. When I completed the first story here, when I completed the first ground floor, and I allowed you to occupy the house and use it, right? That means you have you're simultaneously receiving and consuming the benefit, right? So that would entitle to consider the performance obligation has been satisfied over a period of time. And the next one, the entity's performance creates or enhance the assets, right, that the customer control. For example, say now you are living in the first floor and this is the office building, and I'm working on the second and third and fourth floor. I'm enhancing it, right? So that's another criteria that need to be met. And the third one, the entity's performance, right here, enforceable right to payment, right? So the entity, I have enforceable right for the payment. I've completed it, so I have enforceable right. I can enforce the payment, right? So these, once these conditions, three conditions are satisfied, once these three conditions are satisfied, that would say here, these are the if one of the following three criteria, right? So if one of these criteria are satisfied, so that would make me entitled to consider the performance obligations can be satisfied over a period of time, right? And I can consider the revenue, I can recognize revenue. If 400,000 was the complete contract, I can recognize in my books 100,000 when the first floor is completed, right? That's there. And then here, let's look at the financial reporting part, and it's the same as that. The first paragraph, it's the same as that I've covered there, right? About the performance obligations satisfied when the entity transfers the good, that's here. These paragraphs are the same, and then the performance obligations satisfied over time, right? This three paragraph is what I've done here. So what if the addition, what we have in financial reporting is this bit, when a performance obligation is satisfied over a period of time, and we can measure, the performance obligations will be based on the measure, right? By measuring the progress towards the completions. We, like I said, 4 stories, when I complete the first floor, it 25% of the work is completed. So measuring that work completion percentage, right? There are two methods in which that we can measure the work. One method is known as the output method. That means like exact some similar to my example, right? Meaning that we look at the completed work output. Out of the four floors, one floor has been completed, output of the work. Based on that percentage completions, I would measure the completed percentage, right? If the 4 story 100%, the one floor 25%. Right. So likewise here, so a proportion of the work completed based on assessing how much of the finished product is completed. So you can carry out surveys of performance completed to date, or appraisal of results achieved, time elapsed, or units produced, right? Based on this, these are the measures in which that we try to, based on the output, right? Number of output. For example, unit produced means example could be I promise to deliver 500 uh, bags, school bags, right? Out of which that if I if I finished 100, so you can see like 20% of the work is completed, so likewise, right? And now the input method is where it depends on the input materials, input resources, right? So based, for example, if I measure that I need 300 hours to complete this work, and then I completed only, and so far I have committed with 200, say 100 hours of work, right? So if I just want to say like, let me change it. Say like it was 400, total hours needed was 400, and then I have completed 100 hours of work. So that means based on my input hours, 1/4 would be 25% of the work would be considered as satisfied. So the examples of these kind of performance obligations satisfied over period would be constructing a bridge, constructing a building, dam, ship. These kind of examples where that you would find performance obligations are completed over a period of time. I hope this is clear. This is a step 5, right? So let's quickly show you what else next. Then we will be looking at contract cost, and like we did in fixed assets, in the when you do fixed assets, when you have incidental cost, right, and those kind of incidental cost will be considered as capitalized costs, and then we would add them to the asset. Likewise, we're going to look at the contract cost, what we're going to do with contract cost. Then the next slides we would focus on presentations, in particular the difference between a receivables. Here you would gonna find out the main difference between a receivable, what is receivables, and what is a contract assets, right? What is payable and what is contract liabilities. These kind of things, that distinctions we're gonna find on the presentations, and then we're gonna look at some specific type of transactions, right? For example, principals versus agent, sales with a return of sales with a right of return, consignment arrangements, bill and hold arrangements, warranty. Some specific examples, common types transactions, we're going to look at them. Then we have this activity 4 and 5. And then we have sales with the right return, specific guidance, ethics. And they finally the questions, right? Complete in detail, complete video recordings. I would